So be quiet.
Okay, so here is Ripple. These big bars represent either whales that are being patient and or market makers that are being patient. These tiny bars represent smaller orders of whales and smaller orders of market makers. This is the fluctuation range that they intend to get filled. And then these lines represent the levels that they don't intend to get filled. However, if they do get filled, they're prepared to average in higher or lower depending on the direction. So at any given point, there's enough fluttering orders on both sides to fill the swings and make profit on the smaller swings. And then if an impatient whale comes out, like here, the market makers get massive fills. And when they get their bags filled down here, they have incentive to pump it at least up to the old level that they didn't intend to get filled, because nobody else intended on that getting filled either. So everybody is stop lossing around here. They're entering longs around here. And so there's a lot of buy pressure that will come out after these levels that nobody thought the price would get to. Is that making sense so far?
Yeah, one of the main problems I've always had with trading light is determining if it's a buy or a sell bar. But basically, I just kind of assume that above is a sell and below is a buy.
Yeah, so usually these larger orders, they don't actually intend on getting filled. That's why they're walls. People think that they're real, and yes, they're real, but they don't intend on them all getting filled. And if they do get filled, typically a bigger move comes because of it. So we have this, we can call this like they're being choked. They're choking the price here with small amounts of money, automatically chasing the price. And the bigger amounts of money that they don't intend to get filled are these walls. But whenever the price gets down into these walls, the market makers' bags get deep into the asset. And now they have an incentive to pump the price at least up past the fluctuation range into their other end of their walls. And so in this case, the market makers bought a bunch of XRP that they didn't intend on buying this morning. And then they just let people think everything was normal, hunky-dory. And then when the sudden increase in buys come out, that was their perfect opportunity to go ahead and pull these walls that everybody anticipated staying. And then it triggers a bunch of stop losses on the shorts around this level, and it triggers a bunch of stop buys around this level. And then a short squeeze takes place and FOMO takes place. So once the price gets above this, A, they've already taken a lot of profits out here, but B, now they have incentive to, it's basically price discovery all over again. And so with the bags that they accumulated down here, what they couldn't exit up here, they are now front running the price up, front running, and they're not actually getting filled. They're just scaring buys higher and higher, scaring buys higher and higher. And then after they get their real bag, their second level of average in filled up here, then they stop front running and then they just put a rug down. And that's where they're underneath the buys and they pretend to let the buys think that they're safe. And then they'll just keep following the buys up, pretending to be a rug that follows them. And meanwhile, their average outs are up in this range. And they basically stay that rug support until their average outs get filled. Then they pull the rug and then flip entirely short, where now there's too much sell pressure to even go that way anymore. And then they can make money on the way back down. And that looks like this. So you have walls that you don't anticipate to be filled. And then you have walls over here that don't anticipate to be filled. They actually filled them. They pretend everything's normal. And then as soon as they get any help at all, they pull these walls. See, they're pulled right here. And up it went. And then as soon as it triggered all these levels going higher, then all the idiots came in. And then somewhere around here, they stopped front running the bids and started averaging out with limit sells. And the idiots market bought into them. And once the majority of their bags were emptied, then they flipped entirely short and put a new wall up, which scared it down again.
Yeah, you can see the intensity there, the dark, the bright green.
Yeah. So in this case, I don't know what's going to happen next, but typically we can anticipate reversion to the mean. So in this case, this is the mean. It's the middle of the gap. And so for now, they're probably fluttering around the top and the bottom of this. until enough pressure comes out one way or another. Then they'll pull their tiny orders and let price discovery resume up or down. And then they'll establish a new channel, probably within this range and this range. And then you have day traders that are going to come in at the pre-pump level and try to bid it back up at least 50%. And if FOMO comes back in, it could come back up to 70, 80%. And if it gets up to this level, the market makers will probably front run it back up to slightly new highs to spur longs one more time and fill their bags higher and then flip it back down to the old pre-pump level again. So it's all about creating an illusion of support and illusion of resistance. If somehow those illusions get filled, the market makers flip a switch and they go fully bearish or fully bullish and pretend to be FOMOers with the FOMOers. And then after they empty their bags, then they flip on the FOMOers and send it the opposite direction, which causes a max amount of loss for the max amount of money. But this is precisely why the market can stay irrational far longer than you can stay solvent, because the support is a lie, the resistance is a lie. Where you think the price can stop is only an illusion. Market makers know this, and that's because they're the ones doing it. Everyone else has to just assume. And if you want to trade on a regular basis, you have to rely on those smaller ranges, like I was all day this morning since this time. So I averaged into a short here, and I got mainly filled right here, took profits here, averaged into the short again right here, got mainly filled, took profits here, averaged into the short right here, got mainly filled, took profits here. And then here, I averaged in and didn't take profits here, and I looked away, and then it was up here. I was like, oh shit. And that's what everybody else was doing. Everybody else was also making easy money, and the market makers go, ha ha, boom, and send it up. So that the only way you can avoid this is if you embrace uncertainty and you assume these walls are not walls, and you go at least one more ATR up. So if you go to a higher time frame, like the 15-minute time frame, those ATR, what the hell? The ATR rule holds more true. So actually, we're gonna have to go to like the 30-minute time frame. Yeah. So I don't know why it's not stretching. See this average swing size right here and this average swing size right here? It's basically about the same. So you can already anticipate that amount of swing either way. So a good rule of thumb is take the swing and add on to it. So if this length is from 36 cents to 40 cents, that's a 4-cent swing. You want to add on 4 cents to that, which would be 44, and average in from at least a whole swing away. That way, when they pull the rug or pull the resistance, you're not caught holding a bag at a much worse price. So that's the learning lesson, is that at any given point, the market makers can get more filled than intentional, and they'll flip the opposite direction and exhaust the buying pressure or exhaust the selling pressure until there's no more, and then they'll come out as support again. And that's what always happens. They take the other end of the move whenever possible, and they are able to do that because they are the fakers. Everyone else is real. The smaller people, they don't have the money to fake. So they're in it for the small moves, and they're only gauging the small moves based on what the market makers are showing is the average small move. And so since they're the ones controlling these swings and basically being the heartbeat, at any given point, they can stop being the heartbeat and freak everyone out and flip them either long or short. And then once they notice that the momentum is slowing down, then they flip the opposite direction and send it at least back down to the mean, which is typically a 50% retrace.
This all makes perfect sense. Okay. It actually it fills in a few elements for me that I was having a little trouble.
Yep. And so with a pump and dump, for example, what they do is they accumulate really low. See how it's more cluttered here? This is where they have a tight grip and they don't have the walls. See how there's no big sell walls? They're not interested in selling. They're in accumulation mode. And so they're just buying more. And then they have some super thick walls here that don't get filled. They move them down, and then some of them get filled here. And now they finally have enough really cheap money that nobody else wanted to sell to them. And then they do that pump up to 32 cents and do that pump up to 50 cents because they got filled way down here. And I signaled to buy XRP if it fell below 25 cents somewhere around this time right here, and then it fell right beneath it and then rocketed.
Yeah, I missed that one.
Yeah, a lot of people missed it. I don't remember if it was gold or silver or what, but yeah, that happens all the time. So pump and dumps, they accumulate really low when no one's paying attention or when oversold conditions are present from like the SEC lawsuit or charges or whatever. And once they're able to buy maximum oversold conditions and nobody else wants to even sell into them, they know that's the bottom, and then they just start buying everything in sight. And then about right here, people start noticing, oh shit, something's different, and then they start buying everything in sight. And then once that happens, then even the idiots know something's up, and they start FOMOing in. And then at this point, it's like 50% idiots, 50% market makers pumping their own bags. And then by this point, the market makers are not even accumulating; they're just front running. And then usually by the final quarter of the move, if not the final half of the move, they're focusing on emptying their bags. And once their bags are empty, they let price discovery finish. Once no more idiots want to buy it, then they average into sell side, and people realize there's way more sellers up here than they anticipated, and down it goes again. So it's all about letting the price do its thing while still selling higher than anybody anticipated and still buying lower than anyone anticipated. And then whenever it wants to move away from those walls hard enough, they just pull their orders and let it do its thing and take the other end of the trade when the momentum dies off. That's market making 101.
So I have two questions, but do you want to maybe wrap up the video before you?
Yeah. So any more questions about the market making side and pump and dumping?
Well, I have two related questions, but if you're making a video, just we'll keep them out of it, I guess.
Okay. Let me stop the recording.